Hey, what's going on, guys? Welcome back to another episode where on this episode, we're going to talk about arguably the most famous valuation metric in the value investing community, and that's price to book value. And so we're going to talk about, just the basic math around this particular metric and how to really interpret it. And so let's just dive right in. Okay, so like all other metrics that we've been discussing so far, price to book value is just another ratio. And so really, there's really two ways of calculating it. You can get to price to book value by doing market capitalization divided by the equity value in the business. That equity value you can extrapolate straight from the balance sheet and from the most recent fiscal period. Or you can do price per share, which you can just get right off of Yahoo Finance, divided by book value per share. So ultimately, it's just some measure of price divided by the equity value of a business. And so just the one thing, I'm going to throw around book value, equity value, shareholders' equity. They all mean the same thing. And so I'm just going to throw those words around, and I just need you to understand that they mean the same thing. So if you aren't familiar with what book value means or with what equity means, essentially, it's simply the net residual value of a business after deducting out all of the liabilities associated with that particular asset. And so whatever's left over is what shareholders or equity owners have claimed to from that residual value that's left over. So, and that residual value is the equity. So, quick example, let's say you had purchased a home for $100. You put down, you financed it with $75 in financing from a mortgage, and the remaining balance, you put your down payment of $25. Well, that asset is $100. You strip out the financing or the liabilities of $75. The net residual value at cost is $25. That's your shareholders' equity or your book value. That's just really short. That's how to think about it. And in accounting, arguably the most important formula that you're going to have to be familiar with is assets equals liabilities plus equity. If you were to just kind of reverse engineer that formula, you can just get to equity equals assets minus liabilities. That's essentially just another way of thinking about how to look at or how to arrive at your equity value. I just want to make one quick note, which I think is extremely important. It's that the book value or the equity value of your asset is not the same thing as the market value of your equity or your asset. Book value is always established on the basis of your cost, and market value is, whereas market value is not. And so you need to be able to understand and establish that dichotomy. And I want to kind of bring that point a little bit further home, utilizing that home illustration that I was just talking about, where you had purchased the home for $100. You put down $25 in finance or equity, and you got $75 in financing. Now, let's say from a month from now, the real estate market in your, where you had purchased your home, it's really heating up. Asset prices are inflating, and now your home value is worth $125, whereas it was previously worth $100. So what is the market value of your equity now? Well, the market value of your equity now is 125 minus 75, which is equal to $50, whereas the equity that you had put down was $25. From a book value accounting standpoint, your equity value is still going to be recorded as $25, whereas the market value is double that, $50. So that's kind of really important to understand, which is oftentimes the book value may not be reflective of economic reality. That's something that you're going to have to be aware of as you kind of do your own fundamental analysis, your own research in companies that you're taking a look at. So here are some basic interpretations on the price to book value. If I come across a particular company and I notice that it's trading below 1 from a price to book standpoint, and I noticed that it's being offered to me at 0.8 times or 80% of book value. What that means to me, or it informs me of, is the fact that I can buy the underlying residual assets at a price that was below what management had paid themselves. So if I were to think about a scenario where, let's say, management had bought an office building for $500, put down $100 in equity, financed the rest, and they put the company up for sale, and they put it for sale for they put the equity value up for sale for $80. Well, they put in $100 in equity, and now I'm able to buy it for $80. So I can get access, or I can own the equity in that commercial real estate building for less than what management had paid. That's kind of how to interpret that price to book ratio in this particular context. If they put it up for sale for $125, then the new price to book ratio is going to be 1.25 times. So that's kind of how to interpret the price level of a particular company relative to its equity. Okay, so enough of the theoretical talk here. Let's just actually dive into computing the actual price to book ratio on a real company. And let's use Netflix as an example. So if you go ahead and take a look at my screen here, Netflix, I have the computation for you right here. It's price, shares, to get to the market capitalization. Market capitalization divided by the equity of Netflix is going to get you to your price to book ratio. So let's actually go ahead and pull up what the price for Netflix on a per share basis is as of today. So let's just round it out and use an even number. Let's do $370. Shares, where do I get the shares outstanding on a particular business? Well, you get it from the 10K or the 10Q, which you can extrapolate from the SEC Edgar database. So I have it here already. I'm just going to do a quick control find, punched in weighted. Weighted gets me to weighted average common shares outstanding. Let's use the diluted number. So we're going to do 451.244. And that means your market capitalization for Netflix is $166.9 billion, give or take. And now your equity. So this is the 10K that I pulled up for Netflix. I'm just going to navigate to table of contents, and then financial statements and supplementary data. That's where you can pull up all the financial statements. Let's scroll down. Okay, consolidated balance sheet. This is the balance sheet for Netflix. So their total shareholders' equity as of year-end 2018, as of December 31st, 2018, is going to be this number right here, 5238765, and that's in thousands. So we're talking about billions here. So this is going to be 5238.765. So Netflix's price to book ratio is 31.9 times. So 32 times price to book. That is a very large number, but you're looking at one metric alone. So it could be the case that Netflix is trading such a high valuation, 32 times book, because it's such a productive company or asset that it's generating a level of income or net profits that are so high relative to the equity value of the business that it's trading at such a high valuation, or it just could be overvalued. But you'd have to do a deeper dive. The price to book ratio isn't going to be the best metric to use when valuing or trying to understand Netflix. You'd probably want to use better metrics out there. And we're going to discuss that in the next episode. Which industries or which segments of the stock market does it make more sense to use the price to book ratio versus other industries. I think Netflix is probably not going to be the best company to analyze under the price to book lens. I'll discuss that a little bit more later on. But with that being said, this metric alone, if you were absolutely stubborn about using the price to book ratio, you wouldn't use this metric alone. You'd probably have to run a comparables. You'd have to look at its peer group and see where its peer group is trading at, and kind of gauge, okay, where does Netflix's price to book stand compared to its competitive peer group. And so that's kind of how to arrive at the computation for Netflix's price to book ratio. In the next episode, like I said, I'm going to discuss just a few more nuances about this particular metric, how to actually employ it, which industries makes more sense to use. And I think there'll probably be a few more practical things that you can extrapolate from there in terms of how to utilize the price to book ratio. So without further ado, I'm going to leave it with that, and I'll see you on the next episode. All right, I'll see you guys. Bye.